हाय गाइस, वेलकम टू अनदर एपिसोड ऑफ ऑल थिंग्स कंपाउंडिंग। आज के हमारे गेस्ट हैं मिस्टर विवेक शर्मा। ही इज मेंबर ऑफ द फाउंडिंग टीम ऑफ अ फिनटेक प्लेटफॉर्म कॉल्ड गुलक एंड डायरेक्टर एट एसटी इन्वेस्टमेंट्स। अगर आप एक स्मॉल केस इन्वेस्टर हैं तो आपने इनके स्मॉल केस प्रोडक्ट के बारे में जरूर ही सुना होगा। इनके स्मॉल केस प्रोडक्ट्स हैव बीन वन ऑफ द बेस्ट परफॉर्मर्स सिंस इंसेप्शन ऑन द प्लेटफॉर्म एंड ऑल्सो द मोस्ट पॉपुलर वन। इस कॉन्वर्सेशन में हमने उनके इन्हीं स्मॉल केस प्रोडक्ट्स की इन्वेस्टमेंट फिलॉसफी के बारे में डिटेल में बातें की। वी टॉक्ड अबाउट द मल्टी फैक्टर इन्वेस्टमेंट स्ट्रैटेजी जो ये फॉलो करते हैं अपने स्मॉल केसेस के लिए, एंड मिस्टर विवेक ने बड़े ही आसान भाषा में समझाया कि वाई मल्टी फैक्टर इन्वेस्टमेंट स्ट्रैटेजी कंटिन्यूज टू outperform the indices at very low volatility rates for years to come, especially in a place like India जहां पे multi-factor strategy काफी ज्यादा इन्वेस्टर्स फॉलो नहीं करते। इसके साथ ही साथ वी ऑल्सो टॉक्ड अ लॉट अबाउट हाउ इंपॉर्टेंट behavioral finance is if you want to master the art of investing. If you're interested in knowing all of this, stay tuned because we are starting right now. Hi everybody, welcome back to another episode. Today I have with me Mr. Vivek. Thank you so much, Vivek, for doing this.
Thank you, Kashish, for having me.
So I wanted to start the conversation, right? Taking a step back and revisiting the last conversation we had, wherein you made a very bold statement saying that learning investing is awesome. Like you must learn the skill of investing, but then again, active investing is not something that every other average investor should get into because it doesn't make a lot of sense for them, and they're better off with different financial products, be it mutual funds, small cases, and whatnot, right? So that was a very bold statement to make. So why is it that you feel so? What's the rationale behind you saying so?
There are two things. First of all, if you see, just by following the basic index funds or ETFs, you can actually do better than say 70 to 80% of the market participants. So you don't need to spend any time to do that, right? And you will be better off than 70 to 80% of the all market participants. Personally, it's a pretty good deal actually, right? That is one thing. And second thing is, again, to do active investment, there are two ways to go about it. So first thing is, obviously, if you go passive, you are still better off than 70% of the people, and it doesn't need any time. Now, in order to do active investment, again, there are two ways to do it. Either do it through active funds, or you learn to do it on your own by stock picking. Now, here again, I like to quote, there are many research being done, and the output of all of that research is, again, people who do get involved in active investing, which is individual stock picking or market timing, it reduces your returns by around maybe 3 to 4%. So let's say if an index over long run, if it's giving say around 12% returns, if you actually get involved in market timing and picking individual stocks, your actual returns will be around maybe 8-9% only. So you're spending so much of your time, your own time, and you're underperforming the market. I think it's pretty clear that most of the investors, when I say most, more than 90-95% should not get involved in this, right? The other way to, maybe if you do want to invest in active funds, there are certain other ways. One is obviously the active mutual funds. You can try out active mutual funds, or the second way is through small cases, right? So through small cases, you have access to multiple managers and multiple sort of maybe themes, you can say, or factor investing. Any idea that you like, you can, it's available on small case platform. And that is, I think, pretty decent way of not spending your own time, and maybe you're paying a small fees to the manager in order to invest in that specific active fund. So again, for 90-95% of people, you don't need to spend your time on figuring out which is the best stock to buy, or actually, or market timing. All of these things yields negative returns.
So I think I totally resonate with you here, because most of the people who join the market think that they're part of that top 5% who will actually beat the market, but not everybody can be part of that top 5%, and they tend to overestimate their skill and luck and their ability to do
Exactly,
that.
exactly.
And that is where most people lose
Yeah,
out. And I'd also like to quote a very profound thing that one of my mentors said, that even most of the mutual fund investors actually underperform the underlying mutual fund that they hold, because वहां पे भी वो
yeah.
टाइम करने की कोशिश करते हैं कि अभी
Exactly,
मार्केट
exactly.
अभी मार्केट हीटेड है, लेट्स टेक सम मनी ऑफ, अभी चीप है. So they try to time it, and in the end, they tend to underperform the only mutual fund that they were actually holding, which it's so stupid.
Exactly. See, it's the case with all the financial products. So even if you have, let's say, invested in any of these best mutual funds or best small cases, most of the people will actually underperform because they will try to time the market. If you just stay invested, irrespective of whether the market is overvalued, is in bull phase or it's in bear phase, uh, you'll do at least as much as that active fund is doing. But
Mhm.
you actually, what you have said is pretty right, that people tend to underperform these funds as well, even if though they have identified. So the point here is identification of a good fund. That is not the most important thing. So even though you have identified a good fund, not necessarily you will get those returns, because you have to stay invested. You have to stay with it in all the bull and bear phases. Only then you will realize those good returns.
Absolutely. Talking about good funds, right? And small case. You too have a small case under your brand name Estee, under the Gulaq umbrella, right? So why don't you
Yeah.
tell my audience about what do you do under your Estee's small case, and basically what's the investment philosophy that goes behind picking stocks under your small case basket?
Okay. So in ST, we have been doing this thing for more than a decade now. And it's only now a couple of years back we decided we want to build products to actually advise or help retail investors manage their money in a better way. That's how Gulaq got launched. And now we have Gulaq portfolios on small case, and we are into factor investing. We are the experts in factor investing. Now, a factor, I think these days factor investing is getting a lot of traction and interest in the market, and mostly due to momentum investing, right? But what is happening is, obviously, momentum investing is just one small part of factor investing. Yeah. So it's something. Let me start with factor investing. What is factor investing? It's pretty simple, so to say. Uh, Let me give you an analogy regarding, let's say, cricket. So let's say I ask you, Kashesh, that you have to form your own team, IPL team, right? So you will pick few batsmen, you will pick few bowlers, a wicket keeper, right? So on what basis, let's say, do you select batsmen? So there could be different factors. The factor could be how good he has performed in last 1 year or last 1 month, right? How good that batsman have scored against spinners or against fast bowlers. So these are different factors on the basis of which you actually pick a specific batsman or even bowlers, right? Same way, you can pick stocks. You can pick stocks on the basis of different factors. It could be that a stock which has done well in last 3 months or 6 months, I'll pick only those. So that is a form of momentum investing. It could be value. So you are just picking stocks which are undervalued, let's say by P to E or P to B or whichever metric you choose, but those are undervalued stocks. Or you want to pick high quality stocks. So which would mean factors like having much more stable earnings or growth in earnings or high ROCE, all of these factors. So depending on all of these different factors, what we at ST or Gulaq do is we have identified hundreds of these kind of factors, right? And the problem starts that, obviously, you have identified these 100 factors, but there are times in market when they work and there are times in market when they don't work. So even with momentum investing, what happens is, if the markets are going up, momentum investing tends to outperform the market, right? uh, this as a factor. But when the markets are sideways or when it is coming down, they tend to underperform market also. So if the market in the bear phase, if it will lose say 20%, Momentum strategy is likely to lose more than that. It could be 25 or 30, right? So I think the second step of actually, first step is identifying these specific factors, but the second step is more important in this, in which what we do is identify in this type of market regime which factors are likely to work best, whether it is momentum, quality, growth, all of these factors, which factors are likely to work best in the next foreseeable future, and give more weights to those type of factors. So the way it helps is, obviously you might not be the best performing fund in any one specific market scenario, but if you see over a longer run, you are much more diversified, you're getting much more consistent performance, and you are most likely to beat the index also by a fairly good margin. So you get this outperformance, but it helps you with the stability of your portfolio as well at the same time.
Okay, so what I can make out is ki you follow multi-factor strategy wherein you have different factors as your arsenal of
Yeah,
weapons, and as and when
yeah,
the war ground changes, as and when the markets change, आप अपने अलग-अलग weapons लाते हो and you use them according to the scenario, which allows you to consistently do more than, like, better than average throughout periods, irrespective it's a bull market, a bear market, or a consolidation happening throughout. Am I right to conclude this?
exactly. Yes, exactly. Yeah.
Fine. So, if I was to ask another question, key primarily all these factors that we've discussed, right? These are fairly quantitative based factors, right? Like you can define what
Hmm.
value is by saying, let's say, a low PE or a low PB, and then you can define what
Yeah,
momentum is, like maybe stocks touching 52 weeks high, and maybe the
yeah,
RSI is strong, right? So maybe these are few
yeah.
a very quantitative based way. So I just wanted to understand, key, why is it that a quantitative based way, especially in today's scenario, जहाँ पे such quantitative information is easily available, that such strategies still work? Shouldn't they be arbitraged away, maybe? Or just to ask it in a more better way, how is it that this is so simple? In a way, अगर मैं सिर्फ कुछ quantitative factors या फिर कुछ quantitative metrics को देख के एक अच्छी consistent performance ले सकता हूँ, why is it possible? Shouldn't this be arbitraged away over time?
A very good question. It will be arbitraged away, definitely in some time, but there are two things here. First point is, why is it working right now?
Hmm.
It's working, first of all, because not too many people right now, if you see in quant investing or factor-based investing, it's maybe very low level overall. If you see the 100% of the market, maybe it's 5 to 10%. I don't have the exact number, but it's pretty low still. People who are actually investing based on these factor models. So it's still very low, at least in India. If you consider US, where it's, I think, more than $2 or $3 trillion is invested in factor-based funds, it's very tough to actually extract alpha from these specific individual factors. So that is one thing. India is still in its infancy. And second thing is, because one specific factor will not work in the longer run. So we have just seen last 1 or 2 or 3 years when we have seen these factor investing become much more maybe mainstream, if I can call, but uh, these won't work. A specific one factor strategy won't work in the longer run. So as I explained about the momentum, it's working these days, but it's not likely to work, let's say, for a decade. There'll be few phases, and these phases will be couple of years as well. It's not that few months it will not work and then it will start working. It's going to be couple of years when it will not work, and then again it will start working. Same thing has happened with value. So value was not working. Value as a factor was not working for maybe 7, 8 years. But now I think since last year or so, it has again started working and outperforming even momentum, right? So the secret sauce, I think, with Gulaq portfolios would be in the second part, where I think people know about these factors, but the second part is in a specific market regime, which factor is likely to work more. Like you know about sector rotation, right? Money keeps on flowing from one sector to another. Similarly, you have this factor rotation as well. During different market regimes, different factors are likely to work well, and that is the secret sauce in Gulaq portfolios. Whether momentum is more likely to work, or low wall is likely to work, or quality, or what kind of factor. And so to say, these are the most popular factors. But as I said, we have identified more than 100 factors which work not consistently, but at any point of time. So it could be, let's say, a stock getting included or excluded from an index. So if a stock is coming into an index, obviously that's good for that specific stock, right? So we also, before, if you have identified it is coming, then obviously you have some edge. But what we also try to do is identify before actually it's getting included, which are the stocks which are likely to get included in it. And this is not done qualitatively but quantitatively, right? We look at sector rotation, we look at options data, we look at what stocks mutual funds or financial institutions or even insiders are buying or selling. All of this is analyzed by our models, and the edge that we get is, obviously, we are able to analyze so much of data which is kind of impossible to analyze by manually. Actually, even if you have a team of 5, 10, 20 analysts, it will be very, very difficult to actually analyze this amount of data for the whole industry as such.
So I guess
Yeah.
you guys have a holy trinity wherein you have vast amount of data, then you have proprietary models, and then there's also a tinge of absence of actually human bias, because यहाँ पे all the decisions that you're taking are based on already set factors, wherein you, let's say as Vivek or as a fund manager, won't really be able to, I'm assuming, क्या बोलते, change the weightage just because they feel कि हाँ, just because you, let's say you have an intuition कि maybe maybe this works or not. Am I safe to is it
Yeah.
right for me to conclude this? Also, there's another thing that I
Exactly.
wanted to know.
That's the point. That's the advantage of following a quantitative and systematical strategy, actually.
Another thing
Yeah.
that I wanted to know, ki, do you also have, let's say, set limitations on how much
Mhm.
weightage do you give to a certain factor, irrespective of, let's say, what market are we in? Let's say, so assuming a hypothetical situation, we're in a raging bull market, and it makes
Yeah.
sense ki you are overweight on momentum strategy. But does it mean that you go all in or gung-ho on momentum, or do you have set criteria ki boss, हमें इससे ज़्यादा weightage
So
नहीं देनी?
yeah. So Kashish, the way it works in with our models is, we don't have explicit numbers that momentum could be only, say, 30 or 50 or 20%. So we definitely do not have explicit numbers, because what this is saying is, again, this is my opinion or my view, that momentum is, say, more important than, say, quality or any other factor, right? So that human bias is getting introduced, even though it's a systematical strategy. This is the way actually human biases could be introduced. So we are actually very careful about these specific things, even when we are making our models. But having said that, the systems are designed in a way that eventually any such one specific strategy doesn't get too much of weight also, right? So we don't have explicit number in place, but since we have hundreds of factors, some of them are correlated, but most of them are orthogonal in nature. It it so is the case that any specific strategy or factor or even stock doesn't actually get too much of weight. So it's by design, but we don't have explicit rules around it.
Got it. And the number of
Yeah.
stocks that an ideal Gulaq small case portfolio has. And what sort of consideration do you see in, let's say, top 10 holdings or top 20 holdings?
The ideal, let me talk about two specific portfolios. One is the Gulaq Wealth and Gulaq Gear 6. So Gulaq Gear 6 would have around 10 to 15 stocks, and average would be somewhere around 12 stocks.
Acha.
Sorry, this is Gear 6. So Gulaq Gear 6 would have around average 12 stocks, whereas Gulaq Wealth, which is ideally suited for someone who is investing more than 2.5 lakhs, there it will be around 18 to 20 stocks on an average.
Hmm. So even if you're
So
a
what we have
factor in,
tried to do here is, yeah,
yeah. So I was saying, even if you
what
are
we
a
have tried to,
yeah, go ahead.
what we have tried to do here is, specifically in Gear 6, we saw that a lot of people wanted to enter into factor investing with low capital. So what we have tried to make is make it at a starting point of 24,000. It is obviously, in terms of performance, it is very good. But what we have tried to do here is to keep the volatility of this specific portfolio low. Because you would agree that in order to outperform, if you take more risk, it's, I would say, easier to outperform. But if you have to outperform with a low to medium volatility, that is a tough ask. And that's what we have, I think, tried to achieve, and we have been able to achieve. So if you have a look on the small case and you look at low to medium volatility portfolios, which are under 25,000, which is very hard to achieve under 25,000, I think we'll be top one or two.
Fine.
Based on performance and based on popularity as well. So we have been able to achieve this performance with a low to medium volatility, which is actually, I think, quite commendable.
So this is the exact thing that I was really fascinated about, because when you say the 24,000 mein, you are having a fairly concentrated portfolio of, let's say, around 12 stocks. Because
exactly, 12 stocks.
When I heard about factor investing, I have always thought कि यार at least 100 stocks होंगे. And बहुत ज़्यादा sparsely diversified होगा. Maybe because I don't know a lot about this space. But then you say कि 12 stocks होते हुए भी below average volatility के साथ decent alpha if you're able to produce. I think that's commendable. And maybe your proprietary models are actually working so far.
Yeah, I hope so. Yeah.
So let's before I move on to the next section, in case any of my audience member feels कि they do not want any human bias and उनको कोई ऐसा rule based investing philosophy चाहिए, you can check out Gulaq's small cases. I'll put a link to them down in the description. So moving on to our next section, right? We also talked about we're going to discuss Techno-Funda investing, right? So again, Techno-Funda investing as a concept is very, I wouldn't say new to me, but something that I haven't explored so far. I'm a pure fundamental value investor wherein I just look at the fundamentals and I just don't follow technicals at all. Even though I started with technical analysis in my earlier investing journey, but then I just eventually drifted away as I learned more about, let's say, Buffett or a very conservative sort of old school value guy. So you being somebody who's been into this for quite some time, help me, a fairly pure funda guy, explain what is Techno-Funda and why does it work, and why do you also personally follow this for your own investing philosophy?
So I think what you mean by Techno-Funda is having a mix of technicals and fundamentals, right? Right.
Yep.
So when you say, Kashish, that why does it work? When you ask me, I'll tell you, in my almost 20 years of trading and investing journey, there's no one thing which works for everyone. And no one thing which doesn't work also for anyone. So what I mean is, I have seen traders and investors who just won't bother about fundamentals at all. They'll just look at the technicals and invest. That's it. So they're just not bothered about fundamentals, what sort of results are happening, what news are coming. They'll actually just ignore it, everything. And they'll just look at the technicals. And they're doing very, very well. And then on the other end of the spectrum is, there are players who wouldn't look at technicals and who would maybe just look at the fundamentals or just look at maybe even the price action. So there's some very, very fine traders who don't need technicals or fundamentals. They'll just look at the price and they'll keep observing the price, and based on that, they'll develop that gut instinct or feel for that price. Where is it likely to go? So the point here, Kashish, you or anyone who is getting into it, they've got to realize it. What works for you, you have to figure that thing out. Technicals would work, fundamentals would work, and they'll fail also many times. But you have got to figure out for your own, and it takes some time, right? So you've got to try out these different things, and then you will figure out whether for what thing specifically is suited for your personality as a trader or even as an investor. Right? So you've got to figure this out on your own, and there is no one right answer that Techno-Funda is the best or fundamental only or technical only, because I've seen all over the place, all things work, but you have got to figure out what works best. Again, coming back to cricket, there's one copybook way of playing, maybe like a Dravid. That is the best way. But then you've got Sehwag also, right?
Yep.
So Dravid would play a same ball in very different manner, and Sehwag would play very differently. And if you ask Sehwag to play like Dravid, the way it should be maybe played, he'll definitely fail, right? So even in investing, you've got to figure out what is working well for you. But having said that, I think for most of the investors, 70, 80, 90% of the investors, I think investing in passive funds works well, that's how maybe they should start, and then start exploring how active investing works, what are the advantages and what are the drawbacks of it, and then go about it.
Hmm. So I think the central theme to like everything you've said right now, more of lean towards the behavioral side of the investor, right? Because there is
Exactly.
a
Yeah.
lot to learn, be it technical, fundamental, passive, active, or jitna bhi aap pad lo. I don't think you have an edge in this sense by learning as much, but more of controlling your own behavior when it actually comes to generating
That
that
is the
alpha.
most important thing, because Kashish, earlier when you were speaking about many investors who are invested in good funds, they also underperform
Hmm.
because they keep timing the market, right? So even if I tell you one very good fund, maybe 60-70% people would still underperform that specific fund, because behaviorally they feel markets में अभी bear phase आने वाला है, markets गिरने वाली हैं, तो let me get out. I'll get in maybe 3 months, जब market और 10-20% गिर गई होगी तब I'll enter. या even in bull phases की अभी बहुत ज्यादा overvalued हो गया है, अभी तो market और ऊपर जा ही नहीं सकता, I'll exit now. But market फिर ऊपर जाता रहता है. So to do that market timing, again in our firm we feel to do that specific market timing is very, very difficult thing to do. It doesn't work well for most of the investors. So better to avoid that market timing.
So,
Yeah.
just going on to this tangent only, talking about behavioral finance of it, right? Matlab, can you give me like certain few actionable steps that any individual investor can take to, start controlling or start mastering this side of investing? Because I feel majority of people spend a lot of time trying to learn, the technical aspects of investing. कि financial analysis सीखना है, valuation सीखना है, ये सीखना है. They do dedicate a lot of time, but यहाँ पे I don't know why investors do not really dedicate a lot of time. So what do you think they can do to sort of improve their ability to control their innate aggressive or innate irrational being taking wrong steps at wrong time in the markets?
So I feel it's pretty tough thing to do, Kashish, because जहां भी देखो, be it in social media or news, you have all of this noise which is coming out, right? Market 1-2% गिर जाता है and people are crazy कि what exactly happened, ये कोरोना आ गया या क्या हो गया है. So people will try to figure out reasons behind it. And it's pretty difficult thing to do before happening कि कल क्या होगा market में. But एक बार हो जाता है, उसके बाद people dissect करने लग जाते हैं कि ये reason था, इस वजह से गिर गई, इस वजह से ऊपर चली गई, and this is all noise actually. So I think first thing any investor needs to do is cut out all of this noise, because if this noise is there, it's very difficult to stay the course. So first thing is cut out the noise. Second thing is make a plan for any specific investor. I think what matters more is achieving your financial goals. Less important is actually outperforming the index, right?
Absolutely.
But most important is what your goals are in the longer run, and you should be able to achieve it. So you make a plan as per your risk appetite, what kind of an investor you are, how much risk you can take. Maybe you can't take too much of risk, or you can take too much of risk. It totally depends on, again, person to person. First, figure out what's your risk profile, how much risk you can take. Maybe take the help of a financial advisor in that, but set out a plan that maybe you can have this much in equity, this much in debt, and just follow the course. Be it the markets are going up or down, this is actually, you don't need anything else, frankly. More than 90% of the people don't need anything else. Just figure out a specific plan that maybe you, at this stage, based on your risk profile, you should have 70% in equity and 30% in debt, right? And the next second step is, with discipline, keep adding to it every month. Whatever your savings are, keep adding to it in this specific plan. And let's say if the markets are going up aggressively, so this works beautifully. It's 70-30, 70% in equity, 30% in debt, let's say, for any specific person. Then markets have gone up. What's going to happen is that 70% in equity is going to go up to, say, 80 or 85 in some time. So you rebalance it. So rebalancing, you're taking out from equity and putting it in debt. So just think about it. What's happening is, when the markets are going up, you're booking your profits systematically, right? You don't need to take a call whether it's too high, markets are too high or too low, right? Your portfolio is going to tell you that it has to be 70-30, but now it is 80-20. So I'll just exit that 10% and put it in debt. Again, when the markets, let's say, have crashed. So what is going to happen is, instead of 70-30, वो 70 वाला part जो होगा, it maybe comes down to 50-50 हो जाता है, right? So what again you will need to do is कि put uh, shift 20% from debt to equity. So what is happening here is, when the markets are undervalued, markets have gone down, you're shifting from debt to equity. You're entering at that time, and when the markets keep on rising, you keep on exiting. So it's a beautiful strategy. इसमें कुछ दिमाग नहीं लगाना होता, frankly, कि markets कहाँ हैं, कितनी overvalued हैं, कितनी undervalued हैं, all of those things. You don't need to track any news, frankly. If you track news, you will get biased कि यार अभी तो शायद equity में और ज़्यादा डालना चाहिए. You'll get biased, right? So that, just maybe sit with a financial planner, or if you can do it on your own, do it on your own, but figure out a specific debt to equity asset allocation and just blindly keep putting money in it, and you'll see the results and results won't be visible in 1, 2, 3 years. But in 10, 15, 20 years, you'll be amazed at what you have been able to achieve without doing any other thing, without picking any multi-bagger, any fund or anything. It's a beautiful strategy. Just follow. 90% of the people just need this, and they don't need anything else. They don't need to spend hours and hours analyzing stocks. All those who want to do, they should be doing it, but I don't think people need it so much.
Exactly. So I think the central theme to everything you said is just follow a plan. Be it asset allocations related, follow a plan. Be it continuing with your
Yeah,
SIPs, follow a plan. uh, when you don't have a plan, it is more likely that you get, swayed away by what social media says or what news is saying.
exactly.
So again, we come back to the central theme: just follow a plan which is simple and sound enough for you to follow, irrespective of what's happening. And that, I think, that's very beautiful.
Yeah,
Something even I fail to do, because in the end, I'm also a human, but still, I'm in the
yeah.
process of evolving my plan over time so that I can get better. So, sir, moving on to the last section, right? We've talked about personal finance, quant-based investing, Techno-Funda a lot. I wanted to give you the opportunity, right, for people to know more about what do you do at Gulaq. So we've already talked about, you having a small case. Small case may you're allowing retail investors to get access to those quant-based, factor-based models, multi-factor models, to consistently generate alpha, as we've discussed. Iske alawa, what all services does Gulaq provide that retail investors like us can avail the benefit of?
So first of all, we have these couple of, as of now, we have these couple of portfolios which, as per your risk profile, you can invest in. So there's a Gulaq Gear 3 which has 40% equity and 60% debt. Then Gulaq Gear 5 which has 80% equity and 20% debt. And then we have Gulaq Wealth or Gear 6 which is 100% equity. And all of this, we have been able to outperform the market with pretty low or similar volatility as that of index. So our Sharpe ratios is something like 4, whereas market Sharpe ratio is 1. So Sharpe ratio is a measure of returns over risk. So per unit of risk, how much returns you are able to generate. So it's maybe 3 to 4 times of what an index delivers. So with the same amount of risk, you are able to generate 3 or 4 times the returns. So that ways our portfolios are better. We are actually coming out in next 1 week or so with one portfolio which is specifically meant for emergency fund. Because before investing, and last 2-3 years, I think almost all of us have seen the importance of having a specific emergency fund, right? So we'll be releasing it in a week or so, and it's most likely is going to be very, very low cost product, because that is, we feel, should be the starting point for any investor investing through a specific, first of all, build an emergency fund and then only think about equities or any other sort of investment, right? So we'll be coming out with that. Apart from that, over longer run, we do have plans. We have built beautiful algorithms which will help you in goal-based investing, all of your financial planning, which will be releasing in next 1 to 2 months maybe. But that's our long-term plan of getting into end-to-end all sort of financial planning. But to start with, these portfolios are there, which we have worked really hard at creating, and the results are showing it's one of the most popular portfolios on SmallCase. and you should definitely have a look in them.
Sure. So I think you've built a funnel here, jahan pe through small case you're gathering a lot of audience by showing the sort of returns that you've given so far, and eventually maybe you would attract all of that audience to your end-to-end financial planning solution, wherein based on, as you said, the already existing proprietary technology that you have to help people achieve their goals even faster using all different types of financial products out there. So I wish you best for that as well. So in case
Thank you,
people
Kashish.
wish to reach out to you, learn more about what you do, how can they reach out to you or your firm?
So we have our website by the name of Gulaq.com. People can visit that and have a look at all the information there. And obviously, our microsite is st.smallcase.com. Or you can just write to us. We have our email ID or phone number as well. Just feel free to write to us or give us a call, and we'll be happy to help you. But having said that, all of these financial products, whatever we are creating, the core philosophy behind us is we want to educate investors that the way they are currently doing, or the kind of noise there is there in the market about active investing, that is all wrong. Actually, there's much more simpler way of investing, either passively or even actively. There's much more simpler way of investing, and people should definitely try that out.
And I think that simplicity sort of resonates with sort of products that you have introduced. A factor based model is relatively new, I think, especially in India, and fairly simple. As even we discussed, it just seems too simple to achieve alpha, but still it is. And it will continue to do so, at least in the coming decade or so. So, yeah, again, all the best for that. And thank
Yeah,
you so much, sir, for accepting my invitation. Thank you so much, audience, for tuning in.
thank you, Kashish, for having me.